You know that little moment of envy when someone on your street pulls in with a brand new SUV, and you catch yourself thinking, wow, they must be doing really well. The paint looks wet, the headlights look like a spaceship, the cabin smells like new money, and for a second it feels like you're the only one who didn't get the memo. But sometimes that shiny car isn't proof of comfort, it's proof of pressure. It's a quiet emergency with a license plate. It's a family saying, we needed this to keep life moving, and hoping the math doesn't catch up. Because the real story isn't what the car looks like. The real story is what the loan looks like, and whether the loan is heavier than the car itself. That's what people mean when they say negative equity. It sounds technical, but the meaning is painfully simple. Negative equity is when you owe more on the car than the car is worth. You could have a $35,000 balance on a car the market would only pay $24,000 for. In recent market snapshots, roughly 1 in 4 trade-ins comes in underwater, and the gap is often measured in thousands. That gap doesn't show up on the dashboard, but it shows up the moment you try to sell, trade, refinance, or escape. And the reason it traps people is because most car deals don't start with, how much is the car? They start with, what can you pay per month? If you shop by payment, almost any price can be made to fit with enough time and enough debt. A dealer doesn't have to lower the price to lower the payment. They can stretch the term, they can roll taxes and fees into the loan. They can bundle protection plans and service contracts. They can even roll old debt into the new contract and still make it feel like you got a fresh start. Then you drive off the lot feeling relieved, not realizing you didn't escape the cost. You just spread it thinner over more months. The payment looks smaller. The commitment becomes larger. To understand why this exploded, rewind to the pandemic years. Empty lots, waiting lists, market adjustment, stickers that made your stomach drop. Used cars selling for prices that felt like a typo. In some cases, a 2-year-old vehicle cost more than it did new, and it didn't feel optional. You can postpone a vacation, you can postpone a new couch, you can't postpone getting to work. So buyers walked into a broken market and made the best decision they could in a bad moment. The problem is, those bad moment prices didn't stay. Supply improved. Prices cooled. Used values stopped climbing. But the loans people signed at the peak didn't cool with the market. The loan is a promise. The loan doesn't care what the car is worth today. A lot of people are shocked because they made payments and still didn't climb out. That's when it starts feeling like a treadmill that never turns off, and it comes down to how loan math works. On most loans, early payments hit interest first. On a long term, 6 or 7 years, you can spend the first couple of years mostly paying for the privilege of borrowing, not actually shrinking the balance much. So imagine buying at the top of the market with a long term and then watching the car depreciate the way cars always do. The car value drops quickly, the loan balance drops slowly. That gap is negative equity forming in real time. Let me put a face on it. Picture someone who buys a $40,000 vehicle and puts $2,000 down because rent is high and life is expensive. The taxes, the fees, the add-ons, those get folded into the loan, so the amount financed climbs higher than people realize. 2 years later, the market says that car is worth $27,000. Their payoff, the number needed. To close the loan today might still be $34,000, $35,000. They've been paying, but the gap is still there. Now the car needs tires and brakes. Insurance is higher. The payment feels heavier than it did on day one, so they do what millions of people do. They walk into a dealership and ask for a lower payment. And the moment the conversation becomes lower payment, the trapdoor opens. Because when you trade in an underwater car, you're not just trading a vehicle, you're trading a balance sheet. That $7,000 gap doesn't vanish, it has to go somewhere. If you don't write a check for it, it gets rolled into the next loan. It usually sounds like this: don't worry, we'll pay off your trade. And technically, yes, they will, but the payoff doesn't come from magic. It comes from your next contract. You paid it. You just paid it later with interest. That's how one tough deal becomes a cycle. The new loan isn't just paying for the new car. It's paying for the old mistake too. And if it happens again a couple of years later, the debt gets rolled again. You can end up paying interest on a car you don't even own anymore. People don't do this because they're dumb. They do it because they're stressed and they need reliable transportation. The system offers a path that feels like relief in the moment. The payment is a magic trick. It hides the real cost by stretching time. You don't reduce the burden, you delay it. And eventually, the delayed bill shows up. Now add the second hammer, interest rates. When rates climb, the total cost explodes, even if the car price stays the same. Combine higher rates with long terms and you get this. You're paying for years and the balance barely moves. You make payments, you stay current, yet you check your balance and it's still massive. That's demoralizing because it feels like hard work isn't producing progress. Then come the costs that don't care about your loan schedule: repairs, maintenance, insurance, registration, the stuff that hits you whether your loan is underwater or not. When a car is new, it's predictable. But once you're a few years in, the car starts asking for money in lump sums. A battery doesn't die politely. A transmission doesn't break on a payment plan. And those repairs show up exactly when many long-term borrowers are still deep underwater. This is when people do dangerous math. They start delaying repairs. They drop coverage because insurance is too high. They're trying to breathe. But it increases the chance of one accident turning into a disaster. If you total a car and you're underwater, the insurance payout is based on the car's value, not your loan. The check can be thousands short of the payoff. Without gap coverage, you can end up with no car and a remaining balance. Gap coverage can help, but it's not a magic shield. What matters is understanding the risk you're carrying. If you're putting little down and stretching the loan, you're basically choosing a higher chance of being underwater for longer. And when budgets finally snap, repossession enters the story. I want to say this clearly. Repossession is not always a character flaw. Sometimes it's a household doing survival math. They look at a huge payment on a car worth far less than what they owe, and they decide, I can't keep sacrificing rent, food, and sanity for this. So they stop paying, not because they don't care, but because they care about surviving. Repossession is usually quiet. The car gets sold, often for less than you'd get privately. Fees get added, and if the sale doesn't cover the full balance, you can still owe a deficiency. So you lose mobility and you keep debt. That's the double punch. So what can a person actually do without pretending everyone can just write a check and walk away? Start with a simple habit: know your numbers before you make moves. If you own a car, you should know your payoff amount and your realistic market value. The payoff is the number your lender quotes to close the loan today. The value is what similar cars are actually selling for. The difference between them is your underwater gap. Once you see the gap, decisions get clearer. If you're only a little underwater and the car is reliable, keeping it longer can be the smartest move. It's not exciting, but it's powerful. Every extra year you keep a paid-down car is a year you're not paying sales tax again, not paying dealer fees again, not restarting depreciation. If you want to speed up escape, the most efficient money you can put into the car is money that reduces principal. A small extra payment can shorten your underwater period, especially early, because it reduces interest you would have paid on that balance. If you're thinking about refinancing, understand what lenders look at. They judge you, but they also judge the collateral. If the loan is far above the car's value, many lenders won't touch it. Pay it down into a normal range and refinancing becomes more realistic. Now, if you're buying a car soon, the biggest win isn't getting approved. It's buying in a way that keeps you above water. That starts with price, not payment. A down payment is protection. It keeps the loan balance closer to the car's value as it drops. A shorter term keeps you from spending years underwater. And a boring, reliable car you keep for a long time will build more stability than a stylish upgrade every couple of years. Also, watch what gets stuffed into the loan. Add-ons can be useful, but many are overpriced. If you finance them, you pay interest on them too. If you wouldn't borrow money at your loan rate to buy that add-on separately, think twice about rolling it into the deal. And here's a detail people miss. Trading too often is expensive even when you're not underwater. Every trade repeats taxes and fees. Every trade gives you a new loan schedule, where early payments are heavy on interest. Your bank account rarely wins that game. If you're stuck and you feel trapped, don't let shame keep you silent. Call the lender early if you're sliding. Sometimes there are hardship options, sometimes there aren't. But waiting almost always reduces choices. And if you're ever considering voluntary surrender, understand what it is. It might reduce the stress of a surprise tow, but it often doesn't erase the debt. The deficiency can still exist. The credit impact can still be serious. It's not a clean reset. That's why I call it the underwater garage. Because from the street, everything looks fine. The car starts, the driveway looks full. But inside those loans, there are families who can't trade, can't sell, can't breathe. So next time you see that shiny car in a driveway, don't assume it means someone is winning. Sometimes it means someone is carrying weight they can't talk about. And if this story feels personal, you're not alone, you're not broken. You were sold a payment, not a price. The fix starts with one boring question that changes everything. What is this decision actually going to cost me? Not this month, but over the next 5 years. Once you own that math, you stop getting tricked by the shiny parts. And that's the goal here. Not to shame people for needing a car, just to make sure the next time you sign a car contract, you're signing it with your eyes open, not just your hopes.